Welcome to this Technical Analysis Basics series webinar on stochastics. My name is Alan Brugler. I'm the president of Brugler Marketing and Management. I've been practicing technical analysis for more than 40 years. Our topic today, overbought or oversold, and when should you care? This is a way of looking at the stochastics as an indicator for financial decisions. We are registered as a commodities trading advisor. First step has to be this disclaimer. There's a substantial risk of loss in futures and options trading. Such trading may not be appropriate for all individuals or entities. Past performance is not necessarily indicative of future results. This presentation is not to be seen as an endorsement of futures and options trading versus other hedging or marketing techniques. A few basic tenets of technical analysis before we get too far. We believe that traders open their wallet before they open their mouth. If there's news, they are free in the commodities markets to act on that without publicly disclosing the information. Money flow from those decisions by traders leaves a signature and price movement that can be detected with technical analysis tools. Those technical tools measure the flow and the distribution of the money in the market, creating a supply and demand for money. When too much money is on one side of the boat or one side of the market, it will flip over. The existing price trend will end. There are many different classes of technical analysis tools, each used in a different market context. One such class is the oscillators, so named because their plots on a screen can resemble an oscilloscope display with wave behavior between defined limits. Oscillators are designed to identify situations where prices have gone too far to be sustainable in one direction and must return from that extreme to the mean or the average. Those extremes are called overbought and oversold. In an overbought market, the market is too bullish. It being long or on the buy side is a crowded trade. It's the fashionable thing to do. In a classic overbought market, it's made the front page of the local newspaper or the TV headlines. The term overbought is essentially a measure of sentiment, but eventually becomes a measure of liquidity. We asked this question: how many are on one side of the boat is too many? The answer is, of course, it depends if you're her dad. Oversold is a mirror image of overbought. The market's too bearish. Being short or on the sell side is the popular thing to do. The term oversold is essentially a measure of sentiment, but eventually becomes a measure of liquidity. One very simple measure of an oversold market is one where bad news fails to make the market move lower. You hear a headline, it's terrible, and the price doesn't drop. We call that situation sold out. Tricky part here is to define that bad news. It can't be something minor. It has to be something the market's aware of. So how do we measure these market sentiment extremes? A traditional measure was the bullish consensus back in the 80s. That was a weekly survey of published recommendations by advisors and brokerage firms. It was very slow due to publishing delays and somewhat subjective in whose opinion was being surveyed that week, but it did set up an index of how many people were recommending buying and how many recommending selling in that market. Some faster acting and readily available tools were developed through the computers in the technical analysis industry. Oscillators including RSI, Stochastics, Williams %R, and CCI, the Commodity Channel Index. Overbought and oversold levels vary by market and by the length of data used for inputs. As we look at these different indicators, they can be set with different numbers of days or bars in the indicator, and that will influence the level of the reading that you see. Now on to stochastics. There are several variants of stochastics, including fast, slow, and raw. The raw and fast versions tend to be very noisy and hard to see on a screen, popularizing the slower version with its smooth data and more readily readable lines. Slow stochastics are plotted as two lines, the %K line and the %D line, with the latter a moving average of the former. The minimum value is 0, the maximum value is 100 for the stochastics, although to be technical, you can't go all the way to 0 or all the way to 100. It would be 99 and some decimal. This is what stochastics look like on a chart. The lower half of this dollar index chart. The blue line is the %K, and the purple line is the %D, which is, of course, a moving average of the %K. In this case, a 5-day moving average of the last 5% Ks. Because the moving average is going to lag the underlying %K value, it will run below the %K in an uptrend, and then those lines will cross at some point when the trend reverses. For convenience, we've highlighted the overbought and oversold zones. For stochastics, that's generally 80 for overbought and 20 for oversold. So when we get up above 80, we believe that the market has too many people on the long side and is starting to have liquidity issues. If I can highlight this, here, this would be an overbought area in August of 2018 for this US dollar index chart. The %K and %D are both above 80, and then you see the lines cross. Notice that coincides with a high in the dollar index, and that following that crossover, the market dropped for about 2 weeks. A similar thing happened in early October. We got into the overbought territory and then sold off. Again, by convention and popular practice, stochastics are considered overbought when the %K reading goes over 80. They're oversold when %K drops below 20. A sell signal develops when the %K is over 80 and then drops below the %D, the crossovers that I showed you. In some situations, you want both to drop below the 80 before acting on the signal. A buy signal develops when the %K is below 20, then crosses above the %D line. In some situations, you want both to rise above 20 before acting. Going back to our previous slide, you can see some oversold situations here as well, where the market has gone into that sub 20 range and then subsequently rallied. Over here at the end of the chart, also into the 20 range, and we were starting to get a rally at the end of the data. RSI is another oscillator. It also uses a 0 to 100 range. It is a little less sensitive in some situations, so the key numbers for overbought and oversold are 70 and 30. We've highlighted the areas over 70 in this US dollar index chart, but it's used similarly. You go over 70, when it starts to roll over and drops out of 70, that's a sell signal. We've highlighted 3 places on the chart where the oscillator got overbought and how the market sold off after that had occurred. You don't have to display it the way we have been doing it here. Here's another charting example of an RSI plot from AgriCharts using the Brugler website. Again, it's a single line. The 70 line is not clear on this type of chart, but I can point to the high there on the 15th and the reversal that happened when it did get above 70. %R, not to be confused with the RSI, is a very raw oscillator. It can actually be a component of stochastics. As you see, it's a lot noisier, a lot more erratic in the plot. This happens to be a 14-day %R, but it's somewhat similar to the other oscillators in that when you go to low values, in this case close to 0, you expect the market to rally, and when it gets up into that 90 to 100 area, you expect the market to sell off. You'll see some exceptions here on this chart, which we'll go into here in a few minutes. Here's a different plot of the percent R using, again, the Brugler website, and in this case, a candlestick chart. But you can see buy signals there for that percent R indicator illustrated in red. Now, here's another illustration of RSI, and keep in mind, very similar to the stochastics. We'll look at the very end of the data, and this could be a stochastics reading of 80 or an RSI above 70. Would you say that this market's overbought right here? I think you would, because we are above our 70 marker. The market has had an extended rally. What happened next? It was, in fact, overbought. I've highlighted the next few weeks of that chart. You can see the reversal on that high day. The RSI backed off below 70, gave us a sell signal. The market did sell off for several weeks, became oversold, and then rallied again after that. So again, overbought and oversold, you're looking for extremes in sentiment in the oscillator to be accompanied by turns in the market. And of course, you use this going forward. I did want to highlight the fact that these can be short-term signals and not necessarily the high of the year, the high of the week, the high of the month. The slide here is that same December corn chart, only going through to expiration. You'll see that the sell signal that we had been focusing on paled by comparison with what happened later. The end of the previous slide is marked by that arrow. Prices did slide down for a while. The RSI got oversold several occasions, and then we rallied sharply to new all-time highs in corn later on. So again, a sell signal is good when it happens, but it's not necessarily a major reversal. Now, to make effective use of these oscillators like RSI and stochastics, I believe you have to adjust their lengths to fit the underlying trading cycles in that particular market. This is a classic error when new users start to use the cycles and use the stochastics. You can't just bolt on a default 14-day stochastic and expect it to work in every market. What you want is for them to give you some usable information telling you when the market is topping out or bottoming out. So you want the oscillator to turn at about the time the market's making those reversals. A key warning here, don't over-optimize to get the result you want. I run into people all the time that say, well, I really want to be bullish this market. If I turn that stochastics down to 5, I can get an oversold signal here. That's not the right way to do it. Here's how you do it. Cycle counts are low to low. So you look at a chart, you check at least 3 complete swings, low to high, high to low, etc., 3 times through. Figure out the number of bars between those lows. And by convention, we count low to low rather than high to high. Once you've got that, let's say it's 8, 10, and 12, the average would be 10. Set the RSI or stochastic length to that average, and then see if it turns at about the right places on the chart. George Lane, who popularized stochastics, said that stochastics are not predictive. If it signals before the turn, you don't have it set up right. Because remember, we're trying to measure overbought and oversold sentiment. We want to know when everybody's in the pool. All right, here's an example. This happens to be gold, and this is another key point for us. You can have these indicators can be used on a wide variety of different financial instruments. They can be futures, they can be stocks, they can be bonds, just about anything with appropriate adjustments for that particular market. In this case, we've done a count of 6 different cycles in gold. And we've highlighted those turning points, and we've averaged it, and they're running 20. This is a weekly chart. They're running 27 weeks apart. So we've set the stochastic to 27 bar look back, And we're still using a 5-bar average of those percent K values to get our percent D. How well is it working? All right, here we're over, and this is the 20 line right here. I'll kind of mark it across so you can see it. All right, so here's a buy signal right here. We've dropped below 20. Market took off. Here's another buy signal down below 20. Market took off. On this one, we didn't get all into oversold territory, so we have to ignore it, which was a good thing, unless you were a very short-term trader, because it went up to new highs. You'll notice that it works on overbought as well. Here's an overbought above 80, just at that peak there, and the market sold off. So this is as a rough math, this is working pretty well. Now, a couple more hints. 27 weeks is a long time in a lot of markets. And if they're 2 to 3 weeks to turn, that can cost you a lot of money sometimes. For a faster acting indicator in a market with a very long cycle length, and I would consider 27 weeks to be pretty long, set the bar length to an even fraction of that cycle length. So that the sub lengths, the smaller ones, will still end up in the same major spots as before. That means in a 30-bar cycle, you could have 2 15 bars or 3 10 bars. In a 45, you might have 3 15s. The point is you want them to be evenly divisible so that on the main count that you've already figured, they're still bottoming or topping at that area. As we go further in the presentation, we want to watch for divergences. We want to watch for right knee and left knee crosses. And another key point, since stochastics measures overbought and oversold, values in neutral mean nothing. If those two lines cross at 50, it is not a signal in the stochastic. It may work for a day or two, but it's not a valid signal. All right, here's our same gold chart. It's still the weekly chart, only we've gone with a 9-week cycle. Remember, the main one was 27, the one that we identified with the 6 counts there. But let's look at how going with a 9-week helps us or hurts us. We're still going to get the major turns at the same places that we did before. You'll notice that, however, that on this break, we did get to oversold, which was not true with the 27-week. That gave you a buy signal that allowed you to capture this little move here. You got a nice sell signal up there with a little bit of pain for a week or two off of that major high at 1400. To complete the point, we're taking that same 27 weeks, dividing it by 2, roughly 13 and a half weeks, or we use 14 here. But again, you want the major crossovers, the oversolds, to be at the same points that you had on the 27-week. You're just going to get some intermediate swings that you can pick up by using a shorter length. Another illustration. Cattle market has a traditional 45-week cycle low in cattle going back 20 or 30 years. We've identified that with this 45-week cycle in the stochastics here, but you see that it's extremely slow acting. Okay, you can go months and months. Here's September 2016, October 2016. We finally get a buy signal. We get a sell signal in May of 2017. Another buy signal, September 2017. These are very long moves, and you'll notice that because of the length, there are some fairly major highs here that don't get overbought. All right, it's just too slow acting. Same thing with this one here. It never really gave you a sell signal. There were other indicators that we used that would tell you to sell, but not the stochastics. All right, so this is a prime candidate for a shorter cycle setup. Let's go to a 15-week stochastic, which is there are 3 15s and a 45, and you'll see that it does, in fact, become a little more active. Still oversold there, still oversold here, but we got a better signal here and here because it's more responsive. I do need to talk about being pegged. This is a mnemonic that I use in my classroom instruction. Oscillators at a near maximum reading are like a speedometer that's maxed out. I hope your car has 160 miles per hour on its odometer. In every class I ask, has anybody ever driven over 100 miles an hour? And in every class, almost inevitably, at least 1 or 2 hands go up. But the point is that if you have an analog speedometer on a car, there's usually a peg, or about where my cursor is pointed there, that stops that needle from going back around to zero. If you have your foot on the gas and you're going 160 miles an hour, that needle will hit the peg and it will bounce. It will bounce as you hit bumps in the road. It will tell you you're slowing down when in fact your foot is still on the gas. This is the concept of pegged. In a strong trending market, the oscillator, the stochastic, the RSI will be at 100 or very close to it. It will tend to back off due to day-to-day price action. It'll tell you that the thing's getting ready to reverse, but in fact, it's still in a strong trend, and you need to stick with the existing position, assuming it's favorable to you. Here's a good illustration of a strong downtrending market. ADX is one way of measuring a strength of trend. ADX is rising here as the market is going down. That means an increasingly strong downtrend. The bears are in charge and they're pressing their advantage. You'll notice that the stochastics were down below 20 for almost 4 months, a very extended length of time. But you'll notice that there were several crossovers. That's that needle hitting the peg. All right. The foot was still on the accelerator. We were still declining, but the market kept trying to cross over and give you buy signals. You can have 2 conclusions here. One would be, don't use stochastics in this kind of a market where you've got that strong trend. Use something that is better at trend following, like MACD. The other is that you have to be more conservative and wait until it exits the oversold zone, which didn't happen until here, in order to be able to trust the signal. So there's a couple different ways to play with that. But again, being pegged is a very real danger if you're a stochastics or RSI user and the market starts to have a pronounced trend. This is a so-called Iowa trading system popularized by a brokerage over there. It's a 20-day stochastic, but it has that same vulnerability that we were just illustrating. This happens to be using January 2019 soybeans, but you'll see this very strong trend in the ADX. It's very strong sell-off in June and July in that market, but even the 20-day stochastic, which is longer than I usually use, was still becoming oversold, giving you crossover buy signals, and they were not good. They did not make you money until the third one when we crossed above 20. So again, in a trending market, you don't use the oscillator, or you have to use it differently. Here's another example of one that broke down. This is live cattle from a couple of years ago. The market was very oversold, gave you a crossover buy signal, and notice that it got ugly from there. Not only did we go on down, but we broke a 2/3 speed line, which is a major support line, and indicated a lot more weakness in that market. So you can't use the stochastics when you've got the strong trend. How do we know it's a strong trend? The green line, which is the ADX, was climbing even though this price action tried to go sideways for a few days. The downtrend was still gathering momentum. So kind of rebuilding on the point, use trend following tools in trending markets, and don't rely on stochastics. They're much, much better in a sideways or a choppy market. Here's another illustration. Again, rising ADX, obviously pretty visual trend there as well. Stochastics were pegged. They were oversold even back in mid-October. They were trying to get you on a couple of occasions here to buy, but the MACD, which is a trend following system, gave you a sell signal here and was still bearish as this was going on. This crude oil chart was going off at the end of the chart. All right, use trend following tools in trending markets, use oscillators in non-trending markets. A couple other things to look out for. As we're dependent on counting cycles as part of this exercise to figure out the length of the stochastics to use. Be wary of counter-cyclical moves. There are times when the market just goes opposite to what it normally does. This is a December 2018 week chart from Kansas City. You can see that the 30-year seasonal pattern down at the bottom, contributed by Moore Research Center, basically goes down from July to late September. That's the normal pattern for that December contract. But in 2018, it was going the opposite way. What does that tell us? It says that some of our other indicators are liable to behave in less than normal fashion. What you also want to look for is a thing called divergence for both stochastics and RSI. This is a very useful tool. This simply says that the chart action and the indicator are going two different directions. They disagree. You can see that here. The stochastics were starting to go up in this live cattle chart, but the price, even though the stochastic was higher, the price was lower. This is one of the definitions of leadership is looking back to make sure people are still following you. All right. In this case, somebody wanted to be a bear. They sold the low, sold the new lows below the previous day's low, but they didn't have any friends. The crowd had already turned against them. The crowd was already anticipating a rally. And that's a very expensive lesson to have. If you're chasing this little short-term decline and you sell it into that new low and the sentiment has already turned against you. Okay, so that's a divergence where prices go to, this is in this case, a bearish divergence where prices go to a new low, but the stochastics were not going to a new low. You can also have a divergence at the top, and we have one here, where price went to a new high, but the stochastics did not. Again, that's a warning sign that the crowd is not in sync with the people that are buying up here, and the momentum's going the other way. So this, our text is just to summarize what we just talked about. Market moves to a new extreme price while the oscillator fails to do so. We say that the bull or bear has no friends. Some divergences are merely a function of an incomplete move. However, you have to be a little careful with them. You may have another swing later that still takes that oscillator to a new extreme. It's best used as a confirming indicator rather than as your primary. Here's another divergence example. This is from March 2019 wheat. Back in September, you can see the market going to a new low, the stochastics not going to a new low. That's an indication that it time for a little bit of a corrective rally, and that is what happened. So to kind of wrap this up, money often moves market prices before the motivation, i.e. the news, is leaked out. Traders open their wallet before they open their mouth. Technical analysis tells you when traders are up to something, that is, when they're starting to make some shifts in their perceptions. Stochastics and other oscillators are most useful in non-trending markets. They highlight when too much money is betting on the same direction, right? When they're overbought or oversold, there's too much money going that way. Markets are mean reverting, meaning they go back to average over time. That's our last point on the page. That when everything's coming in on one side, think of Bitcoin going to $20,000. That was an order imbalance situation. Prices will eventually reverse the trend. Where do you learn more? Brugler Marketing. We're the experts in technical analysis. We use this stuff every day in our advisory service. We'd be happy to teach you more about how to use Stochastics, RSI, MACD, the Brugler cycle indicator, and all those other technical tools that are out there. How do you learn technical analysis the Brugler way? We have advanced technical analysis workshops a couple times a year in Omaha, where you can get some intensive time with your computer and our instructors. We have Brugler Marketing summer and winter seminars where we teach segments on technical analysis, sort of the bite-size approach. We have the Chart School PDF archives in the SRR section of our website. That is a subscription section. You have to be a client to see it, but we have a number of different PDF files showing different indicators and their application. And of course, these videos, which are part of our chart book service. I'd like to thank you for joining us for this exploration of the stochastics indicator and some of the other oscillators. Again, Brugler Marketing Management is a consulting risk management service focused on the agricultural commodity markets, but we do dabble in some of the others as well. Our contact info is listed here. We'd be happy to discuss our offerings with you or some of the other tools that we've got available. Thank you for your time in watching this video, and please leave us feedback at those email addresses or give us a call.